So should you use a limited company or should you remain a sole trader? Check out this video as we go through all of the details. Hey everyone, my name is Simon Misiewicz. I'm from Optimise Accountants, and in this video we are going to be talking about limited company or should you remain a sole trader. And there are many areas that we need to cover off in this video. So let's get started. Alright, so we want to know how much tax that you will be paying and ultimately how much you can actually save. So we're going to be focusing very much on business tax. Now, the question really comes into this in terms of why do people use a limited company? What are the benefits? And there are three main benefits that I always reference people to. The first one is income tax. So this could be corporation tax versus income tax. And we'll get onto that in a little later. We've got this thing called inheritance tax. When you pass on, can you get some inheritance tax relief? And the third factor is risk. Now, we are going to focus our efforts very much on this income tax, but there are other aspects that you need to think about, inheritance tax, risk, and so on. Now, we're not going to have time to cover that in, but you do need to make sure that you factor those into your plans. Now, when it comes to sole traders that are business owners, they will have to go onto something called self-assessment tax returns with HMRC. And basically you need to know what the dates are, and the dates run from the 6th of April to the following year, or the 5th of April. So it's not calendar years, it's tax fiscal years that you need to be aware of. And when you're doing self-assessment tax return, you've got until the 31st of January the following year to do your tax return and to make your payments of tax. And of course, you've got this then tax on taxable income that's paid. So you may identify the amount of tax you've got to pay. You've got to pay that over, but you may also have to pay an additional 50%, which is called a payment on account for the following year. And there we need to stop, because when you look at self-assessment, you're forward paying your tax liability, which is not something you do in a limited company. Please do just pause that thought and sink that in. Now, when we look at a limited company, though, we are going to be subject to corporation tax, and the tax year, funnily enough, ends 12 months on from your incorporation date. So if you start a company now in, let's say, February time, then you'll run all the way through February and end on January. And that is your business year in which tax will be deemed. Now, I put co-house, but that really does mean company's house. And that is going to be then expecting your set of accounts for that year 9 months after your year-end date. And you have to pay tax 12 months after. Now, typically, I kind of find that really bizarre, because you'll end up doing your tax return and payment of so on like that. But the actual payment of tax is 9 months. But the actual tax return itself is 12 months. It just beggars belief why it's so different. So my view is just stick to that 9 months ruling and ignore this 12 months. I have to put it in because, well, hey, that's what the HMRC tell us. Okay, and then we got tax on due on, but there's no payment on account using a limited company. Yes, you have to pay the tax due on the profits made in the company, but the big difference is that the fact that there is no payment on account for businesses. So how much tax will you pay when you compare your sole trader self-assessment activities versus if you incorporated into a limited company? And you have to really think hard about that. And the problem is that it's true that there are so many facets that we've covered already in this small time frame, but you've got other things that you need to consider, and that kind of doubt would really weigh on you. So make sure that you do get some tax advice from a specialist. It's easy to go on Facebook and YouTube, watch some videos, you read some articles, but is it really going to give you that comfort and confidence that you deserve to move forward with your business activities? And that's where we can come in. So you can book a tax consultation with us. There's links below this video and appearing above my head right now. And if you use code U225, you will get 25% discount. It is about really getting the right tax advice at the time that you need it. So when we talk about sole traders and limited companies and which one's best, what we need to think about is self-assessment, because if you are a sole trader, you will be classified as self-assessment tax return owners, which means you've got to submit a tax return to HMRC based on the profits of you. And that means that any income that you get personally will be taxed. And you will have this thing called income tax banded, and we'll go through the various tax bands that you'll have. And then you've got this class 2 national insurance, which is £3.05 per week. And finally, you've got this other STEL tax, which, to be honest, not many people do a direct comparison of self-assessment tax versus limited company tax. And the reason for that is because it's quite complex. You've got this banded rate, but you've also got, in my opinion, you've got this stealth class 4 national insurance charge as well, which is 9% between £9,501 to £50,000. And you pay 2% on excess of £50,000. So you've got this extra tax that you need to think about. And therefore, when I look at tax returns, as someone says, I'm high rate taxpayer, I pay 40%, and they're a business owner, I have to correct them because I say, well, no, you pay income tax at 40% and you've got this national insurance at 2% plus this extra £3 per week as well. So you're paying really more than 42% tax. And when people say, I'm a basic rate taxpayer, so I only pay 20% tax, so that really doesn't compare to a limited company, because a limited company, you pay 19%, I'm paying 20% on my self-assessment tax return. Why should I use a limited company? Well, actually, you're not paying 20% tax because you've got this element here of 9% national insurance, which 20 plus 9 is 29% on profits over and above £9,500, which is a lot of money. So what's the question? Doesn't matter. The answer is 19%. Okay, so when my fickle kind of answer there is looking at this column here. So for a limited company, you pay 19% corporation tax irrespective of whatever your profits are. So that's easy to calculate, right? Now, when it comes to your self-assessment tax return, that's not so easy because all of a sudden, when you say, well, how much profits do you make? And you say, well, about £70,000. You've now got 3 scale charges that you need to apply to get to your profit number. It's not easy just to calculate. So there is difficulty in regards to look at the scale charges. But what you should be looking at is once you get to this £50,000 worth of earnings, as a sole trader under self-assessment, which is what the SA stands for, by the way, you'll end up paying 40% tax versus 19% in a limited company, which is a huge difference. And it gets worse. For when you're additional rate taxpayer, you're at 45% versus 19% in a limited company. And I do appreciate that people, what they first of all say is, but you need to extract money out of a limited company and pay tax on it. And you are right. So there are things we need to think about on that one. But let us first of all see what difference it is for you to think about using a limited company or not. Okay, so when we're looking at direct comparisons, I think that's the only way that you can decide whether a limited company is right for you or not, because you've got to think about the company setup, you've got the accountancy fees, etc., etc. And therefore, you've got to look at this. And what I'm looking for here is the fact that you've got this £35,000 worth of profits, whether you're sole trader or limited company. And we're just looking at income tax, don't forget. So now we've got these 4,500. This is the tax. So we've got income tax at 4,500 versus the corporate tax of 6,650. Looking at that, so you kind of think, well, what's the point? Because I'm paying less tax on my self-assessment tax return as a sole trader than I would if I used a limited company. And you would be right. Now, there is a difference, though, of national insurance, which you don't pay in a limited company. You pay Class 2, Class 4 national insurance, which at this 35,000 level would come to 2453. Now, that 2453 instantly is a negative when you're making a comparison. But on the whole, even if you added up your tax, self-assessment tax return at 4,500, you've got Class 2, Class 4 national insurance at 2453. you've got a total tax liability of 6,953 of your £35,000 worth of income as a sole trader self-assessment. Now, when you look at your limited company, you pay tax of 6,650. The difference is £303.60. Would I set up a limited company for that? No, probably not. There are other factors of why you might utilise a limited company, but that shouldn't be the really an argument. £303 savings. Well, actually, you would lose that in accountancy fees alone, potentially. So I would ignore a limited company on this basis. But then it gets more interesting when you see someone earning £50,000. So same kind of thing here. Profits along the top here. No difference as you would expect. Tax though, 7,500 on self-assessment tax return versus 9,500. So you're paying £2,000 more tax as a limited company. But the big difference here is now class 2, class 4 national insurance still kicks in at 3,804. So you're now making a saving of £1,804 using a limited company. And again, I know people will come on to this forum quite rightly and say, but you've got to pay tax when you take money out of a limited company. And you would be right. So you do need to get holistic tax planning. But at least this video will show you, just going back to the previous slide, if you've got profits of £35,000, really should you use a limited company if you haven't got to take risk into account and you're just looking at direct numbers? Probably not. Should you automatically set up a limited company even if you have earnings of £50,000? No, you should get tax advice. But what this video should be showing you is that a limited company could work for you. But it's not the be all and end all. So please do get some advice before you do that. And I've created a video which I think you'll find interesting, is how you can take £20,000 worth of cash out of your limited company tax-free. There's a link appearing above my head and in below this video description as well. And I know that some people will say, well, your personal allowance is only £12,500. Well, yes, but there are many various tax incentives for you to extract money out of a limited company and just walk away with the money, not be taxed at all. I've done the same thing with the video of how to extract money out of a limited company. If you prefer to read, then the article will be appearing just above my head and also in the video description. So do have a good read of that. If you're interested of how to extract money out of a limited company in the most tax efficient way, not only should you watch those videos and read those articles, but you can also download our tax calculator of ways of how to extract money out of a limited company. So do make sure you check that out as well. Okay, so now we can look at a two-step process. If you are indeed going to be using a limited company, you do need to be aware that you've got corporation tax to be aware of, and you've also got your self-assessment income tax to take into account as well. And so we look at your corporation tax first. You've got 19% corporation tax, which leaves you with 81% retained in the business. Now, you don't have to extract that. Now, that's the key difference. If you are a sole trader earning £100,000, you will be taxed on all of that income. Now, when it comes to £100,000, you're going to be subject to that 40% income tax, which is nasty. Plus you got your 2%, which is even more nasty. So that's 42% tax versus 19%. Now, if you said, well, I'll move £50,000 out of my limited company to my personal name, yes, indeed, you'll be taxed on that. But the retained money that you keep in the business won't be subject to any further tax at this point in time. And there are plenty of ways, again, before people start coming onto this forum, oh, but you've got to pay tax. No, you don't. There are plenty of ways of how you can take money out of a limited company tax-free. Plenty. So don't listen to the naysayers. There are plenty out there. They will just create that negative vibe, which you really don't need in your life, let's be fair. So once you get to a stage, you've got this corporation tax going on, you do need to put it into your self-assessment tax return, whichever way you earn it. Now, what I've done for you is I've given you this 14,500 way of taking this money out of a limited company. Again, watch that other video though to find out more about that, where you can take another 5,500 at least out. But this gives you some idea. So you've got your personal allowance of 12,500 plus your dividend tax of 2,000. That's 14,500 now out of your limited company, absolutely tax free. So hopefully we've talked about business tax, but there are plenty of other taxes that you might be paying too much on. So do check out our other videos, and more importantly, make sure that you book some time with us, whether it's to discuss our services in general, especially if you're a property investor, or indeed if you just want a tax consultation to understand your sole trader, should you use a limited company, how to take money out of a limited company, all that good stuff, then make sure you book a tax consultation with us using the code YouTube25. Don't forget to give this like button a good old smash up and subscribe to our channel so that you can be notified every time we launch a new video. And don't forget to drop a comment. Are you thinking about becoming incorporated? What's holding you back? And indeed, what advice have you been given that you've listened to? I'll be really interested to hear your stories, but until the next time, my name is Simon Misiewicz from Optimise Accountants. I'll see you again soon.